Good afternoon and welcome to our May. It is the 1st of May, May Day, Peter, our May Day Switzer webinar.
We're not doing May Days, Paul. May Days aren't positive. We're doing other things rather than May Days. But go on.
Right, okay. Well, that was the dulcet tones of Peter Switzer. I'm Paul Rickard, and today we're going to be hosting your webinar. Okay, so let's move on to the obligatory disclaimer at the front of our webinar, just to be very clear, of course, that we don't know anything much about you, and of course the information today is general in nature, and of course before acting on any of the things that we say, we always caution you about seeking the appropriate independent professional advice if you feel necessary. So just as really important, we don't ask you a lot about what the reasons and your personal situation, so the advice by nature is general and not specific, so important disclosure at the beginning. Next, just from a housekeeping point of view, we ask that you, if you can, close the applications and programs that are not in use. Please ensure that the volume of your computer or speakers is turned up to a comfortable level. This is about the volume level I intend to speak at. Peter Casey gets a bit more excited than I do.
Yes, I promise that.
And of course, this is an interactive webinar, and of course you can send in questions during the webinar via the question box. It should be on the like that shows on the screen towards the bottom side. Please send in your questions. Now, what we'll try to do, if we can, is when we come to you, we'll see whether you can actually ask the question. We'll unmute you. If you do have a microphone or a microphone, then you can ask the question directly. If we can't hear you, then we'll just do the question for you. But sometimes people can get a bit more into a verbal question than they can perhaps just on a couple of few words on the bottom of the screen. Just in terms of timing, it's on Sydney time, it's about just after 25 minutes to 1. We would like to keep these webinars to just under an hour. We know a lot of you have got other things to go to, and things are open and markets are open, so we'll make sure we finish by no later than 1:30 p.m. Eastern Standard Time. So that's just to give you a sort of an outset. Okay, Peter, I'm going to fire up with you with a few questions.
Okay.
Time to earn your keep this week,
yep,
or this month. I'm a bit puzzled about what's going on in the US. On the one hand, we've got the US dollar is easing because it looks like the rally's finished. On the other hand, people are saying the Reserve Bank's not going to, Federal Reserve's not going to increase interest rates, so that should be taking the dollar the other way. We've also got bond yields have gone up a touch. We've got the stock markets come off a touch. It sort of seems we've got conflicting sort of statements about, growth wasn't so good, but there's some other data today which is a bit more encouraging. So can you just sort of give me your 2 minutes top and tail version about what do you think is happening in the States now?
Okay, so the USA is a bit perplexed about the GDP number they got this week. It was 0.2%. The consensus was 1%.
This is March quarter, right?
The March quarter. And the March quarter is renowned for being weather affected. Same thing happened last year. They had massive snow problems last year. There were then question marks over the March quarter economic growth figures. It took us another 3 months to find out that, yes, it was weather. It wasn't, in fact, that the economic recovery was weakening. And that's the same thing that's going on now. People aren't quite sure whether this is just weather plus a rising US dollar. We didn't have that last year. The US dollar is now rising. Some companies are losing out because of that. Also, in these figures, because the oil price fell so substantially over the last 6 months or so, a lot of oil rigs have actually been closed down in the USA, and so the growth associated with those rigs, it has come off the boil as well. So there are serious question marks over the economic recovery at the moment. The people I respect say it is primarily weather. I do like the fact that Goldman Sachs put a report out yesterday, a guy by the name of Oppenheimer, who's a well-respected analyst there, and he says there's no reason for us to not believe in the US recovery, and going long US stocks is not a bad strategy. And I guess, and also remember, US stocks, Nasdaq recently all-time high, S&P 500 all-time high.
Yeah, it was only just this early this week, I think, on Monday,
Right,
wasn't it?
correct. So this is just, in fact, the technical analysis says the market should go up. There's a triangular formation on both the S&P 500 and the S&P 200 that we operate off, and so I'm not particularly worried.
Let me ask you this question, though.
Yeah.
I mean, one of the things, the biggest change at the moment versus, say, a month ago is that the US dollar, the rise in the US dollar has come to an end, right?
Yes, correct. That's because the interest rate rise in the US has been pushed out.
Okay,
it's either September 2016.
Are we just correcting, or is this the end of the rise in the US dollar?
Correct.
Just correcting?
Yeah. Look, they know when interest rates rise, the dollar will go higher. But they now think, and remember, all markets anticipate the reality that's going to come down the pipeline. The reality they thought coming down the pipeline was June, maybe latest September, an interest rate rise in the US. Well, now it looks more likely September earliest, 2016 latest for that rise. So therefore, this is just a reassessment. In America, three big players have been operating. One is a lot of people are saying, go Europe. And the DAX this week dropped about 4%. Go to the Greenback. Greenback's fallen this week as well. And a lot of us would notice this, but I have noticed that the healthcare has been a really big play in the US. It's off the boil as well. We're even seeing tech's down a bit as well. There's a bit of an expectation that the recovery will be delayed because of this March figure, but it will come through.
Okay, all right. Now, Reserve Bank meets on Tuesday, 2:30 p.m.
Must you ask me this question?
Yeah, you've been writing a lot about interest rates. In fact, some of our readers have been saying, does Peter ever talk about anything else apart from interest rates? So we, of course, have said, yes, he does.
Yes,
so,
do.
But here's your chance to talk about interest rates again.
Yeah.
So will they cut on Tuesday or not?
I'm qualified as an economist. Therefore, all I can say is what they should do. What they will do relies on psychologists. I know all the economists out there try to guess it, but they're not qualified to guess. They're just guessing. They should cut. I think there's a very good chance they will now. A week ago, I thought they were going to delay. But given the fact that the Aussie went over 80 US cents, I think the Reserve Bank would be just so silly not to get a cut now.
Okay, so summing that up, you're going to say they're going to cut?
Yes.
Both should and will?
And?
Should and will?
I know.
Should,
I'm completely big tip.
Yeah, okay.
Will, I hope.
Do you want to sit any more on the fence, or you're happy to?
Look, I'll say they will, but I don't care if I'm wrong.
Okay.
It's just like asking you, are the Roosters a good football team? You have no qualification to make that judgment.
Did anyone outside?
I'd listen to it.
Yeah, okay, all right. Well, I'm just here to ask the tough questions. You know that, right?
You're doing a good job.
Someone has to. Okay, banks we lost about 4 or 5% on banks the last couple of days.
Yep.
They're sort of holding up a little bit today. Now, so the big thing that happened here this week probably was, I suppose, a bit of a statement from APRA, or an alleged statement from APRA around, the timing of when they might need to put in a bit more capital, particularly around their current weightings that they apply for on mortgages. What do you think on the financials?
Well, I've got to say, Paul, I have not directly added to my holding in banks. I guess when I buy the ETF for the S&P 200, I get banks. I get materials. At the moment, I'm a great believer that we will go through 6,000 sometime this year. Eventually, we'll get to 6,800. So sometimes when I haven't got a company I like, and I've got money to invest, via my super fund, I'll just buy the index. Because particularly when I saw it down 80 points yesterday, wasn't it?
Yep.
I dived in there. Yep. I thought it was a good time to buy an ETF for that reason. But I just think that the banks I hold, I bought when they were much lower prices. I don't need to add. Now, if someone wants to say, should I add now? Well, yes, the answer is yes, you can, but be mindful that when the market sells off, it could easily go below what you buy it. And so
but you're not selling, all right?
I'm not selling that.
Yeah.
No way.
Look,
I bought at good prices. Why should I sell?
Yeah, I'm not adding to them just at the moment, but I was tempted yesterday. I think look, we all know they're going to need more capital, right? It's just this is not new news. a lot of the institutions are underweight and they like to stir it up a bit. The bank's approach at the moment is actually to increase capital through the dividend reinvestment plan, not neutralise those. I think they're comfortable, and the whole thing with some of the APRA staff and Murray and Bale, well, it'll happen, but it'll happen over a longer period than people expect. So yeah. I don't think there's any need to lose faith in that. And I think when interest rates start to go up, you reassess it. Right? Yeah. A bit of a sell-off like the last couple of days, I suggest you was more in a buying territory, an opportunity rather.
I think when Westpac got down to like 36 or so.
Yeah, below 36 is yesterday. We're going to see their results next week. Westpac reports on Monday. So, I give them think they've come off. I think we're probably going to see, we should be looking for some good stuff out of it.
But you can't ignore the fact that there is a belief that the economy is more subdued than we would like it to be. If this economy was growing at 3% plus, the bank's profits would be better too.
Yeah. Okay, let's bring me to March. April, I should say. So this is also just the last thing I want to talk about is what happened in the month of April. So we have the 11 sectors plus the return during the month of April and the year-to-date return. We just talk about accumulation indexes here because really you should be thinking about from a dividend point of view. So year-to-date, the market, if people talk about just the ASX 200, is up by 7%. Adding dividends is up by 8.5%. That's what you should be benchmarking against. But we lost 1.7% in April, and more than that occurred in the last 2 days. So if it's been done in the last in the middle of the week, it'd be a different figure. Interesting enough, I suppose, 2 takes. Every sector is positive return this year. And no one really standing out that much. This is very unusual to have everything in one way and not massive variations.
But consumer discretionary and utilities have done very well.
Consumer discretionary has done very well. It was one of the worst performing sectors last year. Yeah. But there's been some really good stocks in that, which I think is a function of the lower dollar and a slightly pick up in consumer confidence. Yep.
And retail sales have been good.
And retail sales have been improving. Financials, despite the sell-off of the last 2 days, that's your banks, still up 8.8% year to date. So that's more than the index, despite what people say.
And there were a lot of naysayers bagging financials for the last 2 years, which we've been opposed to.
And the other, I think, big mover in April, which is reflected in a couple of questions, has been healthcare, which I think is a function of 2 things, Peter. Both the Aussie dollar has gone up, and a lot of our healthcare stocks are positioned for a weaker Aussie dollar. Yep. And secondly, as you say, in the US, we do tend to follow some of these macro trends. We've had a huge rally in biotech and healthcare. We've started to see a lot of profit taking there in the last month.
I've noticed over the years, Paul, if telco's down in America, they go down here, and I sometimes ask why. Yeah.
So look, bottom line, I mean, obviously energy is your Santos's and your oil search, and what happened in April, oil prices bottomed, so at least temporarily. So that's what it has. So I think the biggest takeout of that is the fact that every sector is actually positive. And there really aren't any broad macro trends I would describe of sectors that are going to benefit from lower interest rates and a weaker dollar. Is still largely intact, notwithstanding a bit of a reassessment of that in the last week or so.
It's part of the reason why I think the Reserve Bank will cut this, the dollar being 79 to 80. They don't want that.
Okay, enough of us talking. Let's go to some questions. I've got a couple here prepared, but we'll do a couple online first of all. Okay. We'll start with Jeff if he's there.
Yes, sorry, I need to go to where my... Sorry, one second.
I'll read out Jeff, what I've got down here. I think you were saying, talking along, if you had some money to invest today, which asset class would you invest in for the next 18 months? Is that the question?
That's right, if you weren't able to change it, that's correct.
And you're going to leave it, yep. So set and forget for 18 months. I suppose the obvious question about this, but let me just throw that one to you, Peter.
Yeah. Jeff, can you tell us how old you are and what's your appetite for risk? Would you be happy to plonk it into a term deposit if they were 6%?
Yes.
Yeah, okay, so we get an idea what kind of investor you are. All right.
Okay, I'm aggressive end.
Oh, you're at the aggressive end.
Towards the aggressive end.
Okay.
Yeah.
Okay. I think the question is shares versus property versus international, Peter.
Yeah.
What do you?
Well, I think property, particularly in Sydney and Melbourne, have done very well. If you're outside of those areas, property, and you buy the right areas where, for example, tenants want to live, particularly in Brisbane, I think that's still got some good upside. But really, I don't worry about the stock market over the next 18 months, Jeff. In 2 years' time, I could be asking, is this enough? Have we done enough? But for 18 months, I wouldn't worry about going into stocks, but I would make sure I'm in stocks that if the market, say, sold off 10, 12%, a correction, I'd be happy to buy more of those sorts of stocks during that correction.
Okay, so I think what you're saying is you're pretty comfortable with Australian equities for 18 months.
Most definitely.
Okay. All right, Jeff, we're going to move on. I've got a question here from John, and it was sent in to us. Peter, it's about Telstra.
Yeah.
Which you can see on the screen. Hopefully you'll be able to see it on the screen, which is did get to a high of about $6.60.
Yeah.
It's today it's off in the low 620s, and look, John's asking a question. Given that Charlie was pretty gung-ho on Telstra, is you still happy with Telstra?
Me personally, I think at $6.20 or anything below it, I think it's still a good buy. You're a calculator here. What's the dividend on 620 for?
Well, it's still yielding over 5%.
Yeah.
Look, John, I wouldn't worry too much about it. Look, the market, the analysts don't like Telstra. They never have. Yeah. A lot of the institutions are sort of underweight Telstra, so you always run into the limits Telstra on the upside is I think a view from a lot of the bigger sized institutions that Telstra is too expensive.
Well, why did you go to 660 for? You go and up and up.
Well, and also bear in mind, you've got to think where Telstra came from. It's come from $2.60 when the future fund, that's Mr. Murray, finished selling in about 2011.
Yep.
It's come from $2.60 up to $6.20. So it's had a fantastic run. And the analysts don't always look at what you and I describe as earnings. They look at lots of things, including breakup value and cash flows. And Telstra is still largely borrowing almost to fund its dividend, or pretty well close to, it's only cash flow just generated. So the analysts don't like it. Look, it's a little out of favour. I think I wouldn't be worried about it at current levels. And just.
Well, here's a fair question. If someone was putting together their portfolio of stocks, and they said to you, should I have Telstra in there?
It would absolutely have to be in there.
That's exactly what I would say to them.
Yeah, okay.
At $7, I might say hesitate. At $6.20, I think it's
okay, next question will go to Tony about 7 Media.
Okay.
In Chulo, are you there?
Yes, can you hear me?
Yes.
Loud and clear. Go ahead.
Okay. Yeah, I just wanted to know what your thoughts were on 7 West Media and their recent entitlement offer.
Peter.
Yeah, I like the business, but I do see it as a speculative play. It's not the sort of stock that I would put into my portfolio as a must-have. It's recently gone for a capital raising, hasn't it?
Yeah.
Yeah. And I think even though Nine Entertainment has surprised me how well it's done, Nine has actually done pretty well. Seven hasn't. Seven's been going up and down for the last year or so, and it's just not one of the companies that I would like to endorse. Apart from the fact that I think Stokes is clever. When the share price is at low levels, I think there's probably a buying opportunity. But to me, it's a speculative stock, and I am worried about the challenges from groups like Netflix and the growth of pay TV, watching television on computers, and all that sort of stuff. Doesn't seem to be fantastic for a company like 7 West Media.
Yeah, I sort of agree. Look, I think you've got a big question. Separate a little bit the question about taking up an entitlement offer and whether you want to be a long-term holder.
Yeah.
You may take up an entitlement offer simply because it's a little bit of a discount, and if you, flick them back out again. So you've got to separate that question. I don't like the free-to-air market. I think long term it's like print newspaper. It's in structural decline. Now, you have Harold Mitchell a lot talking about free-to-air TV and how many people watch it. It's the only way, from an advertiser's point of view, that you can reach 13 million people, whatever it is, every night. So it certainly has some value, but I think the younger kids don't seem to watch much free-to-air TV.
Yeah.
And
they don't buy newspapers.
They don't buy newspapers, and Netflix and the rest of the stuff is out there. And I think you've got to be I wouldn't be investing for long term in that area. I don't like Channel 9 Entertainment. I don't like 10. I don't like 7 West Media.
Yeah, Tony, I recommend you have a look at the interview I did with Harold Mitchell this week as well.
But again, I think just be careful that you may still. There may be some value in the rights, but whether you hang on to it is another question. Yeah. Okay. Got a little question here which I'll just do from Shervinez about Centuria. I don't know whether this has got to appeal to a lot of people, but they've got an unlisted property fund called 8 Central Avenue number 2. And interesting about that is this is the other half of a building in the technology park out at Redfern. And the biggest tenant is 7 West Media, and a related company of that, or a related company of the Stokes family, is the other seller of the unit. So that's how those things tie together. Look, I invested in the first fund, the first half of the building. It was a slightly cheaper price. I like the building. I like the tenants. I like the park. Yeah. This is a little more expensive because it's been revalued. It's paying it's paying an attractive yield. I mean, so that's sort of all the pros. The downside, of course, it's an unlisted fund. It means it has no liquidity. Now, Centuria is a pretty good manager. When you invest in an unlisted property fund, you really got to look at what the exit strategy is, and the stated exit strategy for this fund is to basically sell the building, I think, in about 4 years' time. Now, that sounds great on paper. The question is, can they, and what sort of price can they get? And you've got to believe that. You've got to believe that the park is going to grow in value. In other words, it's going to become more attractive, and that tenants will want to pay more. People to be out there in that part of Sydney. So if you don't really know the area, I suggest you have a good look at it on the map. It's the technology park in Sydney. It's got as an income investment, it's got a really nice set of tenants. They're all really long-term. They're not going anywhere, and you can guarantee the income return on that investment for 4 or 5 years, which is really nice. The question is, what's it going to be worth in 4 or 5 years' time? Now, bear in mind, when you go into one of these funds, they have to buy a building. They pay stamp duty, 4.5–5% to purchase it. And so you've got to recover back all those upfront costs through the capital growth. So that's the risk, no liquidity in the short term, and they can't actually sell it when they want to, and they end up rolling it.
It's a pretty new building, Paul.
Yeah. So look, I look at the prospectus very carefully, and that would be my thoughts on that transaction. Okay, let's go to John, who also a question about Peter, you know all about this. He's got 2 questions, I think. One about the Defender Equities offer and also IINet. The first question, should I participate in the Wealth Defender Equities offer? So you know all about that, Peter. Look,
I think that I like the fund manager. John Murray's got a very good reputation. I like the principle of the fund, and the principle of the fund is that they're taking out basically derivative insurance in the case of the market selling off. And so even though this is a new listed investment company, the actual methodology has been used with bigger institutional clients for quite some time. And some of those institutional clients are subscribing to the listed investment company. Put this way, if anyone asked me, would I be worried about anyone going into this particular fund, my answer to them would be, no, I wouldn't be worried. Whether it actually cracks the returns it hopes to do, well, that's always in the hands of the gods, the hands of the fund manager. The reputation and the history of this fund manager is very good. So, and given the fact that they're endeavouring to minimise the downside, I think there are a lot of investors who like that idea. So, I guess you'd probably call it a qualified tick.
Okay, got a lot of questions here. The other question you raised is, should you hang on to my IINet shares? You've got a bidding war going on typically in these bidding wars, they keep going. I wouldn't be selling them. I'd be hanging on to them. If I was a shareholder in TPG or M2, I'd be worried. Someone's going to pay too much here. Look, the call so far is to hang on because the shares keep going up, and chances are someone will come back with a better bid. So
I agree, Paul.
I wouldn't be selling them just yet. Just play that. Watch the market. The market doesn't think that's over.
And by the way, Paul, this question was actually taken by Tom Elliott on my television program.
What did Tom say?
And Tom basically thinks there'll be more bids along the way.
Okay, Tom's pretty much a guru on that. Okay, we're going to come to Colin's section. Another question here from John on Cochlear. Peter, Cochlear's like most of the health stocks have had a pretty rough week or two.
Yep.
What's your view on Cochlear?
Well, I think it's currency related more than anything. If you look at the 1 year chart for Cochlear, it's really killed them. It's gone from about 55 to a high of about 87 or something like that, and now it's down to 82. Last time it reported, it had a 250% increase in profit. That was February. And I think because it did so well, it was due to come off the boil. You throw in the currency, and that's to be expected. So, if you were, I don't know what price you bought Cochlear at, but I wouldn't be of the opinion that something terrible is going on with the company. I just think that it's had a nice solid rise. The currency effect. Remember, we were all expecting, and Paul would agree with me, we were expecting the currency to be closer to 72 now than 80. Agreed, Paul?
Yeah.
And a lot of people who bought Cochlear and the market players who bought Cochlear would have thought that as well. And so there was a bit of that in advance buying, which probably pushed it up to 87, 88. And now, because we're not sure about the Reserve Bank cutting interest rates, the Aussie dollar going to 80, sell-off to me is just quite reasonable.
Okay, let's go to the analysts don't like Cochlear. They never have, so that's one of the issues there as well. Okay, let's go to Colin. A similar question about ResMed. Let's try Colin if he's out there. Colin from Sydney, is that right?
I am. I certainly am. Can you hear me?
Yeah, sure can. Fire away, mate.
Okay, so we got ResMed reasonably cheap in the high fives, and it's had an extraordinary run. It's gone a little bit soft in the last week or so. What do you reckon? Hang on to them and ride it out, or sell? And if you sell, what are you going to do with the cash?
Yeah, and will you be paying capital gains tax on the gain, or are you out of that little trap?
Oh, look, I think I might be out of that little trap. I sent my poor wife on a transition to retirement task, and these are covered by that.
Okay, all right. I still like ResMed. I do believe the Aussie dollar will fall. I don't think it's going to hang on these levels. And if for example, the Reserve Bank shocked me and did as I've been instructing them, and they cut interest rates next Tuesday, that will help the currency go down. You know what? The chief economist at Morgan's, Michael Knox, truly believes that our cash rate should have a 1 in front of it. Now, I think there's a lot of people out there who don't believe that will happen. There are a lot of economists who think it should happen, but a lot of people in the markets don't think the Reserve Bank will do that. But if it does, that Aussie will go down to 70, 72 cents, and companies like ResMed will be beneficiaries of it. I don't know of anything out there that worries me with the company. Paul, do you have any view on company problems?
Well, the market didn't like its quarterly report with the increase in sales margin, but interesting, Colin, analysts are still very, very positive on it. The target price for the analyst is $9.88. That's a consensus price.
Yeah.
Credit Suisse today has reconfirmed its outperform rating with a target price of $9.80.
And what is it today, Paul?
About $8.25. Okay. Citi reconfirmed its buy rating yesterday, target of $11.01. JP Morgan reconfirmed its overweight rating with a target of $9.70 on Tuesday. So, look, the analysts like it. Whether you want how much prudence you put in that column, I'm not sure, but they've got a lot higher target price in it. I think if you've been on ResMed, you hang on. Look, again, it should do a little better, certainly, if the currency comes off. There was just it wasn't the sales part, it was really the cost part, component of their the production costs or the selling costs. So I think you hang on, give it another quarter, see what happens next quarter. Now, that's my view, Colin. Hopefully we can help you there. Okay, let's go to Greg. He's got an interesting question, and a question I struggle to answer.
Oh, God.
But I'm going to throw this one to you, Peter. We've got Greg
Fantastic.
wants to ask about agricultural shares. Okay, so Greg's got a really good question. And what I asked myself, what are the best agricultural shares out there? Because everyone wants to invest in agriculture. You think you should invest in agriculture, right?
Look, the thing is this. You know what? In all honesty, I think investing in agricultural shares makes a lot of sense. But I don't have a company that I can get excited about. Like when you picked up on Bega a couple of years ago, I liked that. That was a company that I thought had potential. The Warrnambool thing was on. The Warrnambool thing was a good play. There's just not a lot. And in fact, the headline on CNBC this morning was that corn prices are on the way down. Now, how do you work that out? Obviously there's an oversupply, but everyone thinks that there's an enormous demand for those sorts of commodities. It's just like what Buffett said: if you don't understand it, don't invest in it. Now, look, all I can do, I promise you, over the next week or two on my television show, I will pursue it with people who specialise in it. But at the moment, I just do not have.
Well, every beef producer I know, and I don't know that many, tells me the beef prices are going through the roof.
Well,
Going through the roof. Look, we've covered this a couple of times in the Switzer Super Report. In fact, I think just a couple of weeks ago, Tony Featherston covered James Dunn covered a couple of companies down, a couple of Tasmanian companies. There's an almond producer, and I think we covered this a few weeks ago.
Yeah.
Bernard, you saying yes?
I believe we did, yeah.
Australian Ag has had a really checkered run. It's the largest company, but it's still a brave person that commits money to that company.
Because you've got drought as well. Yeah. The prices could be good, but you can get drought.
We'll re-look at that. I'm sorry we're not giving you a very complete answer.
Sometimes we just don't have answers.
But I think it was just a couple of weeks ago we went through a few of them and on a couple of recommendations and a couple of smaller ones. I don't think anyone is yet brave enough to say that the Australian Agricultural Company, which is the largest by a long way, is yet one to sort of front up to. But look, have a look at that and have a look at what that was covered.
And I will pursue it as a key issue on the television show.
Okay, so John, I want to just go back to this because it's a slightly broader question, Peter. I know it's John seems to be asked a lot of questions there, John. So thank you for all these questions. But it comes back to sort of the if you've got a copy of this one. Yeah, this is a bit about views from Tim Samway, large holding in banks at Telstra, what's happened to Macquarie. Look, just to wrap this discussion up, Peter, have you got any more to add to?
Well, Macquarie's primarily just a currency. Macquarie, its business model is miles better than it was, say, 4 or 5 years ago, but it is actually a great beneficiary of the currency. So if the currency is going up, it's going to be affected. It also will go to the APRA backlash that you were talking about earlier as well. I still think Macquarie is a good company.
Okay, so let's put the debate more around banks and Telstra. People being overweight in their portfolios. Where has it sit?
Well, can I also just throw one last thing? I remember what Samway said. Yeah. He was a guy who was against the banks last year. He got a lot of other things right, but he was against the banks last year. His view is the banks have done their damage. He bought them at low prices, and he took the profit as a fund manager. But I don't think there was actually a conclusive view that banks are completely on the nose.
Okay, so look, I mean, I think I'd probably answer this. Go back and look at your index weightings, and they'll tell you just how your exposure is. I mean, banks are about 40% if you add them all up. Telstra's about 7%. You can see the left-hand column there on the screen, 5.7 and 40.4. So if you've got more than 45% of your portfolio in those two sectors, you're overweight.
Yeah.
Okay. Now, I think that Telstra, I can understand an overweight position in Telstra. My own view on the banks, I've moved back closer towards index weight because there's no doubt they will raise more capital. But I'm not abandoning them, and I'm not going below index weight. And if I had 60% of my portfolio in banks, then I'd probably be saying, yep, that's in rallies, I'd be edging a little bit out.
Yeah.
And that's how you sort of would play this. So I don't think there's any reason to panic, but it's also, if you are very overweight, then you've got to say that the signs are there that in the next 1, 2, 3, 4 years, the banks will need more capital, which means raising somehow more shares on the market. The credit cycle will turn at some stage, and you just have to be a bit circumspect. So that's the way I think you've got to play it. You don't panic, you don't go underweight yet, but maybe you use rallies not as a chance to sort of edge a little bit out and just come a little bit closer back towards the index. My advice. Okay, let's go to Robert. He's got a question about QE in what happens when QE ends. So Robert, we'll just fire you off there.
Robert Bauer, are you there?
Okay, so look, Robert's question is all this QE, and which stands for, of course, quantitative easing in the States, Europe, and Japan. I think you want your crystal ball here, Peter. When it ends, doesn't have to be paid out. What's going to happen?
Oh, well, there'll be another crash, without a doubt. Crashes happen. On a 10-year basis, you're going to get a crash somewhere along the line. And the question is, does the crash come early or does it come late? I'm going to get worried, I think, probably. I'll start thinking about being worried sometimes in 2016. It still could be 2 years or 3 years before a crash happens. But the whole deal about QE is that the economy has to improve. So if you don't get an economic improvement in the USA, which we will, there will be problems. If Europe doesn't improve because of QE, there will be problems. So that is something I totally agree with. QE will cause a problem at the end if there's not economic improvement.
Okay, let's go to Jeff. He's got a question on the currency. You're going to be Nostradamus here again, Peter, about the next 12 to 18 months.
Aussie dollar goes down.
Goes down, okay, Jeff. We just got you online, I think, Jeff, sorry.
What are your expectations? What do you think will be the... Oh, sorry, I'm going through a few questions here. What do you think will happen to the Aussie-US level over the next 12 to 18 months?
Yeah, I think the Aussie will see over that period of time at least 72. There are others who think it will go lower, but I think we'll see 72 over that point in time. Could be lower.
Okay, all right. Let's go to a question on Craig on Ramsey. If we can find
You're
Craig
the Ramsey man, Paul.
I am the Ramsey man.
Craig Bishop, are you there?
Yes.
Yeah, loud and clear. Go ahead.
Yeah, look, Ramsey Healthcare's come off in the last week or so, and just sort of been waiting for an opportunity to get in, and wondered whether now might be the time.
Yeah, look, Craig, it's certainly something that caught my eye. It just had a little bit of a pullback, as all health stocks have had. I mean, it's, as I said at the beginning, the worst performing sector of the market in April. And if you've seen CSL's off about 6 or 7%, we talked about ResMed, we talked about Cochlear. I think it's also impacted Ramsey a little bit. Look, there's no news out of Ramsey. It's just, I think, a bit of profit taking. People saying it's a bit expensive. I think that's something that, in a bit of a market panic, a great stock to be looking at buying. You may not be sort of in the market today, but you have a bid in there, and maybe, I'm not sure quite what the technical level would be, but maybe in the low 60s you look at it. So I'd certainly support that. I think it's something you've got to have a stock in. The record of that company is so good, and let's wait. It's also probably, they're also been impacted by the currency because the Aussie's gone up against the euro. Part of this, we're over 72 cents, euro cents. So they also will benefit to some, quite a material extent if the Aussie weakens. So that's part of why it's come off a little bit.
I'd like to have an opinion on Ramsey, but I'm so cheesed off I didn't buy it at $37, and Paul Rickard's been a great beneficiary. I just can't think about the stock.
Okay, hopefully that answers the question, Craig. Okay, let's move on to, has Anthony got a question? All right, you've got two questions, Anthony. I think one we've answered about Telstra, but his other question is about gold. Let's try Anthony if he's out there.
Anthony muted. He's self-muted.
Okay, so I think Anthony, we've dealt with your. Sorry, Anthony, I think it is. I do apologise. I think Anthony, we've dealt with your question about Telstra, hopefully. But your other question is, do you think there's a role for gold in a portfolio? Peter, do you have gold in your portfolio?
No, I do not. It's like my agriculture problem. If I don't understand it, and gold is so hard to understand. If I was really panicky about the world and inflation, I think I could.
You're a glass half full guy, right?
No, I'm a glass really full, not half full. Glass is really full. But one day I'll come in and say my glass is now empty. I don't muck around with this half full crap. It's either full or it's empty. And I think when it comes to stocks, despite the fact there are challenges out there, I still think stocks are the place to be. But gold, I'm not an expert on.
Okay, look, I'm also not an expert in gold. I hate gold, Anthony, because it pays no income. So I don't touch gold, but there certainly is a role for commodities and precious metals in your portfolio.
Well, the GFC hit called gold.
So I don't have any in mind, but that's because I've been more bullish than bearish. But I can see that it's not, if they're held the right way, you don't pay much to hold them. Having sort of like 5 or even 10% of your portfolio in commodities and precious metals is not an illogical place. So I can understand why you would do that. I don't. I said partly because, Peter, I can't work out why the gold price goes up and down, but I don't like it.
Yeah, and also I think if the gold price was at historically low levels and you were really thinking the economic, what was going to hit the fan, that'd be a time when I might have a punt on it. That'd be a really small punt.
Okay, let's go to Leo. Let's see whether Leo's, we can unmute you, Leo. You've got a question about cash and bonds.
Yeah, thanks. Thanks, Paul. Paul, I'm 63 years old and I'm holding about 40% cash in my SMF. Sort of thinking whether it's a little bit too much or should I perhaps play some in corporate bonds or perhaps dividend-paying stocks. What's your recommendation there?
Yeah, look, it sounds like you're probably a pretty, you're not a huge risk taker by the sounds of it.
Well, have been over the years as I'm getting older. I'm sort of winding down a bit, I guess.
You're a young man.
Look,
thanks, Peter.
I think, look, you going from cash to stocks may be a little much, but I certainly would look at some of the corporate bonds. And there's probably 2 or 3 ways you can play that. There are a couple of good corporate bond funds out there. AMP's had a good one that's been around a long time. Hasn't done that brilliantly the last 12 months, but it's good long-term performance. There's a couple other sort of managed bond funds that you can find. The second way, you can look at a little bit the hybrids market, which of course you cross between equities and floating rate notes effectively. Or thirdly, you can go to places like FIG. There are some brokers that sell bonds directly. So I think if you had that much cash, I would be inclined. I think 63 is a very young age to get too conservative, but I don't want to talk into sort of too much risk. I'd certainly be looking, in what I would describe as almost like a riskless asset class like the bond market. And then also maybe if you still feel a bit more inclined, have a look at some dividend-paying stocks.
Yeah.
But
how much money have you got in stocks at this stage?
Round about 250,000.
And what? What percentage is that of your total?
Yeah, look, it's around about 60%.
Okay. Well, that's not a bad exposure, given where the cycle is at this point in time. Yeah, if it was 2 years ago, I think I would be more inclined to say have 60, 65% in the market. But I just think looking around for a bond fund that is paying better than term deposits mightn't be a bad idea.
Yeah. Okay.
All right. Let's go. Thanks for that.
Okay, thanks, Craig. Let's go to Paul's got a question about LICs or ETFs. I think I covered this pretty extensively the other day, Peter. But
on my television show, you did.
Okay, so Paul's question is, we can't get you is LICs or listed investment companies or ETFs or managed funds. Is there a general consensus as to which performs better in the longer term?
Now, you answered this brilliantly on my show last week, Paul, and I asked that question.
Yeah, look, there's a lot of debate and argument about this. One thing about ETFs, you'll get the index, less a fraction. So take that out, so you'll never get better than the index. That's the first thing. There's some of the bigger listed investment companies, the Argos, AFIX, the Miltons in particular, have got pretty good long-term performance records. They're actively managed and charge a very low fee. So if I was looking for an active manager to look at, a broad-based exposure to the market, I would look at a LIC rather than a managed fund. and I reckon they're three you could look pretty carefully at. Where arguably managers can add value in the Australian market is potentially in smaller companies, and that's where you can either look at the LICs or even some of the managed funds there. But look, internationally, the jury's really out on this stuff. There's so much research that tells you that that over the long term, managers can't outperform.
One third do, but they're a different way.
Different group. The Australian market says that in the top end of the market, they generally can't outperform. They can sometimes in the bottom end of the market where it's much less transparent. So look at my article on this week's Switzer Super Report. If I had to put money in the market and I wanted a broad-based LIC or an ETF at the moment, I'd invest in the LIC simply because they're trading at pretty well close to par, and I would I'd be more confident investing in those when there's no premium attached to them.
So when they're trading at a discount, you say LICs are a real goer, actually.
Well, the big ones, yeah. When they're trading at a discount, buy a LIC. When they're trading at a premium, buy an ETF, by and large. It's pretty much how it boils down to.
Okay.
All right. Sorry we couldn't unmute you there, Paul. I want to go back to a couple of questions here. Robert asked us a couple of questions. Robert, I don't think you've got a mic, has he? Okay. His question was, is it safe to get into oil and gas stocks yet, Peter?
No, it's not safe. It's not safe. I don't think they're going to have another collapse in price. I think they'll pretty well stay where they are. Share price could improve, but you asked the question, are they safe? To me, I think banks are safe. They won't go up very high. I don't think they're going to collapse. But oil prices, iron ore prices, they worry me, so they're not safe.
Okay, you had a follow-up question, Peter, which I think we can argue. What do you think about buying apartments off the plan?
I've never done it myself. I would do it. I really thought the product was in a fantastic area where tenants want to live. It was a really good builder with a good history. You can see I'm throwing a lot of things in there for me to say yes to it. It has to be in a fantastic area as well. But there are certain risks with it. Certain risks that, as I say, if all the boxes are ticked, I can see it. But by the way, when they come online, it could be a time when the economy could be challenged, if it's, say, 2 years from now.
Yeah, one of our experts, Margaret Lomas, who a lot of you would know, and does the Your Money, Your Call program on Monday night on Sky Business, which is all about property on Monday nights. Margaret's very, how to describe it, not negative, but doesn't like it off the plan.
Has a lot of reservations.
Has a lot of reservations, better with reservations about off the plan buying, because you pay a huge premium. Also doesn't like the fact that when you come to sell the property, it's not about the, there's premium in buying it off the plan because people sometimes walk away, which prices them up. B, you don't know what you're getting, and C, when you come to sell in 3 years' time, you pay a premium to buy something new as opposed to buying something second-hand.
And can I throw one other thing in, Paul? This was a real-life experience where only about 80 or 90% of the apartments were sold, but when they came to sell, people had brought in, 10% hadn't been sold, and the developer had the right to sell those first ones, those 10% left over, before other people could sell theirs.
Okay, I want to come to a last written question we got from Bob in Brisbane. It's a bit of a look. It's a bit hard on the screen in front of you, but I think it's a good question, Peter. It's really about sort of, I suppose, a sense around timing and the long-term potential for some of these ETFs, some of these LICs. You do have a copy in front of you. But look, I think he's really saying, if you read this question, look, this is really a question about long-term versus trying to time the market.
Yeah.
And should you get too worried? I don't know. I think probably looking at this, Bob, you're well positioned, and if you're looking for, happy that the market's not doing anything over the top, then you just hang on.
No, I looked at Bob's question earlier. I think I agree with you, Paul. I can't see he's got a diversified exposure. He's also got a substantial holding of bonds. I wouldn't be worried, quite frankly.
Okay, all right. Let's go to question from, I think it's Palo. Look, the question is views on the current weakness in CSL shares. Is the $100 mark going to be a reality, Peter?
I don't know. I think CSL is a great company. It's had a very big run. Happily, Switzer Super Report tipped it. Tipped on a TV show as well. You know what? I think it will get to 100, but I think it will take a while. Only because I think the American situation is not as clear-cut. Our currency is not falling as fast as we would like. The currency will fall. I've said 72 a couple of times today. The currency will fall quickly when America is so certain that their economy is doing well. The greenback will go up and ours will go down, and we'll be cutting rates at the same time. So when that happens, CSL will get a very big boost. It's currently 89.98 or around that mark now. It's not far to 100, but I think it's going to take a while.
Yeah, look, I wouldn't be selling because I own CSL, and I think it'll get to 100. It's one of those great companies. It needs the currency to go down, and I think you're right on that point. Okay, Darren's got a question about IAG. I'll just try Darren as a question.
Darren Guyver, yeah.
Yes, I am. Yeah, I just had a question about IAG Insurer because it pays a pretty reasonable dividend, and certainly done in the second half. But there's been a lot of like storms or due to climate change. Just wonder about the stability of earnings going forward because I know they've hit their peril sort of limit with the announcement just recently. But yeah, I just wonder what your thought on the insurers were.
Yeah,
as an income investment. Sorry.
Yeah, so certainly they've been slugged. They've been hit pretty hard because of the storms and whatever. Paul, you're a more expert on the financials, but my understanding of most insurance companies is that when they go through tough times, they do raise premiums, and that often helps their revenue in the short term. What do you think?
Yeah, look, look, IAG has been a pretty good performer for the better part of last year. I didn't quite follow why people were buying insurance companies. I don't like insurance. I just don't like the industry because of this very sort of risk.
The storm curve, yeah.
Well, it's the exogenous risk that you can't control, which is exactly what these storms tell you. In longer term, paying out, big things like storms are good because actually premiums go up.
Yeah.
The next couple of years. But look, nice yield. It's not part of my portfolio. I just don't put the insurance companies on my radar. So
the bottom line is this, Paul. It's currently around $5.80. If you bought it, say $4 or something like that, and your dividend yield's pretty good, I don't think the company's going to fall off the perch. It's more likely to hang around the $5 mark until the premiums kick in. So. But I am with you. I'm not a big holder of insurance companies.
Yeah. When the analysts still are okay, they've got a target price of $5.93. Look, again, I'd rather own a bank than an insurance company. And I know that might sound a bit perverse, but I just think there's less risk.
Well, they've got more control.
More control. They at least potentially can control some of their exposures.
Yeah.
Okay, and finally to wind up this, we're almost at 1:30. Question from Jennifer.
Jennifer Crow, are you there?
Yes, I am. Good afternoon. Look, I was just wondering, when we're working out our sector weightings, in what category do you put LICs because they cover so many companies?
Yep, that's a really good question. Isn't it? It depends on what type of LIC it is. I would. If I had a LIC, for example, through Argo or AFIC or Milton, I'd largely just exclude that whole amount from my calculation.
Pretty well sectored.
Because they're basically going to manage that for you, and they'll be fairly close around the mark. They'll have a few biases, but depending on their objective, they'll manage that for you. If it was a LIC in sort of the smaller companies where, or they're very active, some things sometimes like Jeff Wilson and so on, you probably have to go and analyse his major holdings and take it from there and reallocate it. The fund manager in their monthly performance report should give you an idea about their exposure. Sorry, Jennifer.
No, that's fine. No, thank you. No, that's good.
Okay. Look, I think we're pretty well out of time. I know we're just a fraction over 1:30, Peter. We do like to make sure we're tight on these, so we know people have to get away. Thank you very much for joining us, and we said we hold these webinars at the start of every month. We'll be back next month, and hope you have a better afternoon. Looks like a bit of short covering comparing the market this afternoon, so probably closes a little bit higher, we think.
Yep.
But happy investing, and we'll be out. Peter will be out tomorrow with your regulatory commentary and, of course, our normal edition.